In 1913, the Federal Reserve was given the task of enhancing the stability of the American banking system. The Fed ensures stability in the banking system by altering the federal funds rate, which is the target interest rate set by the FOMC. This is the rate at which commercial banks borrow and lend their excess reserves to each other overnight. With the collapse of Silicon Valley Bank and the banking contagion that spread to US regional banks, Silicon Valley Bank's problems spread to the entire global banking system. And just yesterday, $465 billion worth of value was wiped out due to SVB. In the latest news, the Swiss National Bank to provide Credit Suisse liquidity if necessary. Another global banking financial crisis is commencing right before our eyes. We can see Credit Suisse Group lost 24.24% of its market value just in the last 24 hours. Credit Suisse is Switzerland's second largest lender. Originally founded in 1856, its $7.9 billion loss last year wiped out the previous decade's worth of profits. Global financial markets are all interconnected and intercorrelated. Bankers all around the world are saying it's not going to affect us. Why are they putting these headlines up in the first place? This special video is all about showing you the key market levels that you must pay attention to. We'll go back and look at the global financial crisis and how that emerged and how you can take advantage of the price volatility that will naturally follow. We keep in mind Rule 252 from the Masterclass, prepared and not scared. This is a vitally important rule. You need to be capable of stepping into the market when you see the opportunities. Hi everyone, I'm Ken from CryptoTradingKS. If you like information like this, please remember to subscribe and like. This video, we have one of the best communities on YouTube. When we look at the main markets in the past trading session, what really sticks out is the flight to safety of the bond market. When there's a flight to safety to the bond market, bond prices increase and their yields just fall off a cliff. And we're seeing that right now. We must pay attention to the bond market. It's a very, very big market. We can also see that gold has continued to come up, even though the DXY has come up as well. Why is this? Gold loves a crisis. What we're also seeing is the drop-off in oil. Recently we talked about oil is in a downtrend and it's technically broken support. This is quite problematic because it points to forward recessionary behavior. One good thing that we see is that junk bonds and high-yield corporate bonds have started to stabilize just a little bit, and I'm going to drill into this in quite a bit of depth. What is not good to see is the VIX is continuing to spike. The markets are widely anticipating that the Fed will pause interest rate hikes. And there was good news in economic releases. The core PPI and core retail sales, Empire State Manufacturing Index, the PPI and retail sales were all pretty ugly. And this means that the Fed is doing its job, destroying demand. How does the Fed protect the banking system? It has a very blunt and ineffective tool, interest rates. When the economy gets too hot, what does the Fed do? It raises the federal funds rate, which is in effect increasing interest rates. What we've seen recently as the US Treasuries just take a nosedive because you've seen yields coming down. That's all about recessionary behavior. There's an anticipation the economy will have a crash landing, not a soft landing, a crash landing. This will release massive amounts of volatility inside the market. It's now officially a trader's market and not an investor's market. Right now, there's a 50.5% chance that the Fed will not increase the federal funds rate. But there is also a 49.5% probability that it will increase it by 25 basis points. With the next FOMC meeting bearing down in under 7 days, it's a coin toss right now. What's happening inside the US market has completely rattled the S&P 500. What we see right now is the S&P 500 has cut under a support line. It's losing another support line, potentially. It's very close to losing it. What actually happens if the S&P continues to come down? There's a lot of things that we need to cross-reference and triangulate. There are some really good things to keep your eye on. Keep your eye on high-yield corporate bonds. You can see that gold line here. This is in the lead up to the 2008 GFC, the global financial crisis. What did corporate bonds and junk bonds, what did they do? They followed this blue line. What is the blue line? It's the S&P 500. And notice what the federal funds rate is doing. It's coming down, but it didn't avert the GFC. The damage was already done. If you haven't already, please watch episode 836. This is where I explain what the banking system is all about. We look at the S&P 500 as it began its descent, and it looks really very much like this at the moment. Just please keep in mind, it takes time for things to play out, and that particular episode is really good at explaining what could potentially happen next. One thing that you really want to keep your eye on is what happened to junk bonds and high-yield corporate bonds. If they start to violently dip down like this, please be on notice. When Lehman Brothers collapsed on September the 15th, 2008, that was the largest US bankruptcy filing. Over $600 billion in assets. But look, it took time for the market to actually digest that. When Washington Mutual Bank then later collapsed, it basically triggered the GFC, this huge downturn in the S&P 500. And you can see how high-yield corporate bonds and junk bonds were following through with the S&P 500. You'll also notice that the Fed said, okay, we'll adjust the federal funds rate and we'll just push it down. It made no difference. If we fast forward to the next major problem inside the markets, the C19 sell-off and the US liquidity crisis, you can see the federal funds rate just plummeted and it stayed there. But it could not avert what happened inside the market. We could see that junk bonds and high-yield corporate bonds, as well as the S&P 500, they all came down. But keep your eyes on this. It's very important for you to understand. What do we see right now, today? The federal funds rate is increasing, putting massive pressure on the banking system, actually to try to fight inflation. The Fed is basically destroying the banking system in the process. Well, that's what it needs to do. It needs to destroy demand. What better way to do that than to destroy its own banking system? You can see why it's such an archaic and completely outdated notion. Well, in fact, it did come from 1913. What do we notice here? We notice that the S&P 500 is getting that alert from high-yield corporate debt and junk bonds. We already know that the S&P 500 has lost a level of support. If we can see that junk bonds and high-yield corporate bonds start to spike down, we need to buckle up. Being in financial markets for more than 3 decades and being classically trained as a financial analyst, one thing that you want to do is to stack as many probabilities as you possibly can. When we look at the VIX, the volatility of the S&P 500, we notice over the past 20 years, in March, the VIX typically spikes. It also spikes in October. A lot of people know about October because so many crashes happen in October. Very few people know about the spikes in March, but we do. I'm going to take you through the VIX. It's very important to look at the VIX. If we see the VIX and understand what is happening here, Masterclass students with the EC method, you already see that it's actually overcome several levels of resistance. Now, what happens to the VIX typically is that it spikes. When it's on an upward path, it can really go for it. Just keep this in mind. We don't want to see something like what happened in February of 2020. That was previous just to the market starting to collapse. But if you were actually paying attention back here in January and February and seeing the VIX start to spike up throughout the latter half of February, you would be prepared. It's very important to be prepared and not scared. We've done deep dives into many of these sell-offs, and these sell-offs can have incredible gains in them, but we go long at spot. Rule 138, all investors become traders every time they buy or sell. Investors buy and sell, traders buy and sell. It's exactly the same operation, but it's done with different philosophies and different holding periods. Traders must understand how the market is moving. They can't afford for the market to turn against them. They need to be early. One thing that I want to really point out to you is the fact that the markets typically come up before they dive down, and that's witnessed by the VIX coming up. Look at how many times it actually occurs. The markets are going up when the VIX is going up, and then the markets tank. The markets are going up, VIX comes up, markets tank. Markets are coming up, VIX comes up. Markets are coming up, VIX comes up. Wow. You very much need to keep this in mind. Now, what is happening at the potential point that we're at? It doesn't look like these other times, does it? Because it's not like other times. What we're seeing now is a little bit like on what happened in November of 2018. The markets rallied, came down, wobbled around a bit, had a bit of a rally, and then the VIX really started to spike. What does it actually mean? Are we expecting the VIX to come up like this, like what it did in February 2020? Not really. That's when the world shut down by C-19. It will take time for the banking crisis to unfold globally. All we're doing is preparing ourselves. Make sure that you've got dry powder, but also, equally as important, make sure that you can take advantage of the market. I've heard some people in the crypto industry and quite big influencers say to absolutely ignore the macroeconomic picture. They would be saying exactly the same thing around the time when the C-19 crisis hit. When C-19 hit, the stock market just absolutely tanked, but Bitcoin and crypto tanked more, but it also recovered earlier. If you ignore the macro will run over you like a Mack truck. You might notice that I've done a couple of lines here. This particular line is a support line. You notice what happened when price came through that support. It came back to retest the support line as resistance and then resume down. What are we seeing right now? Price has actually cut under this support line. Is it possible for price to come back and retest support just like this and just trap a lot of retail investors? Not smart money. Smart money knows that this is already a problem, but it's sufficient to trap people on the wrong side of the trade and absolutely the wrong side of the percentage before their positions get sold down. And notice what the VIX was doing at the same time. I also want to talk to you today about the move. The move measures the bond market, option volatility, and price liquidity. It typically gives you about a 3-week window to scale in and out of positions. A reading in excess of 150 says that the Fed has lost control, and under 50 means the Fed is doing a good job. So the real question is are the markets about to pump and dump? What exactly does that mean? Here we saw back in around August, we had a pump up to a resistance line and then a substantial dump down. That is what a pump and a dump means. If you're not sure what a retest means, what actually happens with retest, and it can happen in support and it can happen with resistance. When you have a retest of support, it's retesting if the support is enough to provide more buyers for the price to go up. If it retests and resumes down, that means the buyers are not there, the sellers are. I've been saying for quite a few days we're at a make or break point inside the financial system. This banking crisis has changed the rules of the game. As a trader or investor, and we know that's exactly the same thing, just with different holding periods, you must be very, very flexible. Don't hold on to your position and say, the markets must do what I want them to do. Instead, do your daily three-dimensional risk management. You always know that you control the trade or investment, but the market controls the returns. We cannot force the market to do anything we want. The markets will just do anything they want. But the more you actively learn, acquire and apply your knowledge and your courage, and ditch fear. Fear is the enemy of every investor and every trader. Also be aware that the market absolutely obliterates people that use blame and gambling. Why is that? Because if you gamble, the house will always win. You're already out of synchronization because you're not applying knowledge. If you blame, you're holding on to one position and not understanding that the market moves in waves. You do your three-dimensional risk management at all times. You think, if the market just plummets, what am I going to do? You must make a decision now. You don't make a decision when the market is plummeting. You're making a decision at the wrong time. You must have the knowledge as to what you're doing right now. If the market goes neutral, it just consolidates. What will you do? What are your decisions? If the market rallies and goes absolutely bananas, it goes to the moon, what will you do? You must have answers to these three simultaneous questions at the same time. The market is a mechanism to transfer money from the desynchronized to the synchronized. If you understand this, it loses a lot of the problems that happens with trading and investing. A lot of people say, I don't want to trade because if I trade, I'm taking money from somebody else. That's not the case. When you trade, you're either applying your knowledge and understanding to get into synchronization with the market, or you're not. Everybody becomes synchronized and then they become desynchronized. There's not a zero-sum game playing out inside the markets. Please never think that way. This is the move. Now what we see here, I've just put on the VIX in very light red behind. You can see the move index, which measures bond market volatility and price liquidity. What actually happens with the move? You can see it's inversely related to price action. If I was to swap this around, you'd see exactly what I'm talking about. So let's do exactly that. I've just inverted the move. What is the move trying to tell us about markets? And what is the move all about? The move is about the crystal ball, about 3 weeks of a window it typically gives. Please let me know in the comments, what is the move telling you about the main markets? What do you think smart money is doing right at the moment? Do you think they're gearing up for the next bull run in the stock market and crypto? Or do you think they're going into the bond market? Why is the move starting to spike? It's because of this recent action. When we look at bond prices, we can see the smart money is leaving the markets and coming across to the bond market. That's actually driving bond prices up, and bond yields have become very, very volatile. So hence the spike in the move. You can see there's a lot of panic. Bond holders are basically saying, I don't care about the yield, I just want in. And we're getting a confirmation through oil. Remember, when oil starts to spike down, we need to pay attention. That's often a very, very negative thing. When we look at junk bonds and high yield corporate bonds, we can see they've not plummeted like this. That's a good sign. But remember, things take time in financial markets. You must have patience. Let's start to layer probabilities in, to stack probabilities. When we look at the move, when we look at the VIX, do you think that the support inside the S&P 500 is going to hold? Do you think we've had a break down here? Do you think we're going to get a retest? We've seen this previously. That does happen. Do you think that's going to happen? And do you think a whole lot of people could get caught in the market before the move starts to kick in? Or do you think everything is fine? It's just a thing that will blow over. We've been looking at junk bonds and high-yield corporate bonds, but looking at Bitcoin is a lot better. Bitcoin can give you very, very powerful signals on where the markets could be going. Now, what is this blue line here? What's that about, can you say? That, my friends, is the S&P 500. A lot of people have been saying that the crypto market has decorrelated from the stock market. Does that look decorrelated to you? Please let me know in the comments. For example, when the S&P 500 came up, what was the crypto market doing? Was it going down, sideways, or coming up? When we had this upward momentum in the S&P 500, what happened to crypto? And when we had this downward momentum, what happened to crypto? Now we're having upward momentum. What is happening to crypto? Can you see any correlation here from a directional stance? The problem that we face, the S&P 500 is very lazy. It doesn't trade 24 hours a day. So you get these gaps in price, and therefore you get literally gaps in the S&P 500. But Bitcoin is 24 hours a day, 7 days a week. You get a perfect signal. That's why looking at Bitcoin can be one of the best possible things that you can do. Even if you're only inside the stock market, you can see why. It's very important to understand objective dynamic market structure, and that's revealed through the CTKS method. There's a couple of key levels that we need to keep our eye on with Bitcoin. Bitcoin is currently trading at $24,520. There's a major level of resistance between 25,776 and 25,886. Keep your eyes on this. Now, where does this resistance line actually come from? It comes from all of Bitcoin's price history, not recent price history. And there's something very, very interesting to see. If we look at where Bitcoin and the S&P 500, because they're following each other, if we look at where that recent rally occurred, we would suggest that when we lose support around the 24,200 level, or maybe just a bit lower at around 24,000, it's all over. It will just plummet back. This is using recent indicative price, which will RIP your money, to around 22,000. We can actually see that we've got a raft of smart money support between $23,030 and $23,323. This is why it's important to look at all of price history, not just recent price history. If you want to know what smart money knows, you must use the CTKS method. It's the only methodology that actually reveals where the algorithms are sticking their buy and sell orders in. Also, just like the move, it gives you a bit of a crystal ball to understand where price can actually come down and be supported inside the markets. And also from the exact opposite dimension where it can come up and strike resistance. What I see when I look at Bitcoin right now, it's overcome this short-term resistance. It's being supported down here with a line. This means to me the probability is on that Bitcoin will try to retrace to around this particular level. It could get short-term stopped out around the 25,164, but there's no structural resistance. There's perceptual resistance around there from retail traders. But if we start to lose this support line coming under there, why don't I just draw it for you? One tick. There you go, that's a little bit better. If we lose this actual support, very, very short-term support, we would expect prices to hit around the $24,000 level, maybe just go down a little bit further to around the 23.5, because this 23,030 to 23,323 is actually quite a strong level. It could bounce and ping pong between these levels, but if it actually goes up, and we always use our three-dimensional thinking, it could also go flat, so just be aware of that. But if Bitcoin does come up, because there's not much resistance in here, in fact there's none, if it does come up to around the 25,776 level, That's an advantage that we can take inside the crypto market. As we speak, we're actually seeing price is starting to come up because there's no real structural resistance in this particular area. What does this actually mean to the stock market? Let's reverse engineer. If we get a progression up with Bitcoin, that means that the S&P 500, we would expect it also to come up. Now, we need to put all of this in context. Remember that the S&P 500 has cut under a level of support. It's negatively biased at the moment. If it starts to come up and does a retest, it may do so to trap retail on the wrong side of the trade and on the wrong side of the percentage. This is completely possible, and Bitcoin potentially is showing that a retest may be in order. What if it actually retests and resumes higher, reconfirms this support? That can also happen. One of the things that you want to do, and I remember decades ago, I was always saying to myself, oh my goodness, the economic system is just collapsing. I'm watching all this negative news and therefore the markets must tank. And the markets rose. Don't get sucked into any specific position. Have 3 positions at all times. Down, neutral, and up. Do not just get carried away with the markets are going to go down and that's all they can do. No, the markets are always moving in a wave. Even though the market came down here, this rally has been utterly substantial. As an investor or a trader, you just want to get your timing more accurate. For example, a lot of people say, I'm an investor, it doesn't matter where I buy. Well, if you bought there, that would pretty much be an ouch kind of situation. But if you bought down around here, that would be a better situation. A lot of investors say, I don't want to be greedy. The market doesn't know you. The market participants do not know you either. And you don't know them. All the market does is transfer money between the synchronized and desynchronized. That's it. That's all there is to it. You can see that Bitcoin is an incredible signal, and it incredibly can actually help us to understand where the stock market is going. But remember, when the stock market falls and when it collapses, Bitcoin will collapse with it. Why is this? A lot of people in crypto think that if the stock market collapses, Bitcoin will be safe. It won't get hammered. That is not the case. People need to pay their bills. People get scared. And you'll often find this with gold as well. A lot of times gold will rally on a disaster, but then it will collapse as people realize that they just need the money themselves. I'll just quickly revisit what happened to gold. When we look at the last financial crisis, and unfortunately we have to say last because I believe we're in the middle of one right now, we can see when the market started to understand that things were shaky, gold is this particular line. I'll just make it a little bit bolder for you. You can see that there was a lot of interest in gold. The gold price absolutely rose up. But then what happened, and this is what I've been trying to explain, when there's a lot of anxiety inside the structures, what happens is that gold will sell off. A lot of people think that gold will only rise. You can see how choppy it was in the 2008 crisis. Does this mean gold is not a good thing to be in? Absolutely not. I absolutely adore gold. Gold is fantastic. But you must be aware of the reality of what happens inside financial markets. Don't bet the house on gold. But if you're going to do it at the right time with a trading mindset, and you will do incredibly well. What happened with gold and C19, and we do very deep dives inside the masterclass on all of these topics. You can see gold was rallying up, but when the market sold down, what did gold do? It sold down. There's incredible opportunities to get on the right side of the percentage and the right side of the trade, especially if you're an investor. But please note, gold did come down. It bottomed out and then went on to bigger and better things. But you can imagine, if you actually bought as it was coming down, you would have done much, much better. But that requires a trader's mindset. And now, in the current situation, what is gold doing? It's going up. Have we seen this before? Yes, we have. I'll just give you a little bit of a helping hand. When we look at Bitcoin, what did Bitcoin do in the C19 process of sell-off? It sold off. Everything will sell off. Please be aware of this. There can be some incredible opportunities, but you have to be cognizant and aware of what financial instruments actually do when they're under pressure. Because what's actually happening, Bitcoin and gold, for example, aren't under pressure. The people who hold Bitcoin and gold, they're under pressure. What happened to Bitcoin in the global financial crisis? You can see it didn't exist then. Actually, Bitcoin started its journey as an alternate source to get away from banks. The GFC created Bitcoin. Always keep Rule 252 in mind. Prepared, not scared. The volatility is your friend. In fact, you need to make volatility your best friend. The reason that we keep our eyes so specifically on the S&P 500 it comes from Rule 217 from the Masterclass. No stock market can escape the US's gravity. It's incredibly important to understand just how powerful the US economic system is. The most important thing that you can do right now is to mark up your charts with the CTKS method. You must understand where objective dynamic market structure is. If you don't know, you're just gambling. You can read about the CTKS method at ctksmethod.org. It's also provided inside the CTKS Masterclass. As an investor or a trader, and we know they're basically the same thing, you must have your process, you must have your system. And if you want to get one of the best systems out there, always check the main markets first and world events. Make sure your foundations are in play. Remember that no knowledge means that the market will take all your money. You really need knowledge. Without knowledge, you are consistently desynchronized. Then come back into the crypto market, finding the market's focus. You can see just how important Bitcoin is. And also understand that if you're investing in alts and you don't look at Bitcoin's structure, you're in trouble because Bitcoin controls every single alt directionally. Before you buy and sell, you must master emotional control. That's why positive excellence is so critically important. We had some great comments yesterday on patience and its importance. I think we need to go through that some more because when we look at what's happening inside financial markets, you do need patience because this can take a long time to play out, but you need to get prepared ahead of time. Have a great day or night ahead, my friends, and I hope this analysis has helped you. Kate and I look forward to catching up with you again tomorrow. Bye for now.